JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. Post the US Federal Reserve action to raise rates to 5.25 to 5.50% band in July, G-Sec rates have hardened in the US. The relaxation of the yield curve controlled by the Bank of Japan has resulted in a rise in Japanese bond yields. Wages and salaries growth in the US came in at 4.8% in July 2023, which is the lowest since April 2021. Given the US CPI core inflation follows US wages and salaries growth with a lag, the incoming data points on the same and its correlation gain utmost importance for monitoring. However, US labor market continues to remain tight, although it is gradually moderating at a slow pace. With the recent JOLTS or Job Openings and Labor Turnover Survey, the ratio of job openings to employment still remains as high as 1.5 times. In an expected move, the RBI Monetary Policy Committee unanimously voted to keep the policy repo rate unchanged at 6.5% and retain the stance of withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. RBI has revised inflation projection for FY24 upwards by 30 basis points from 5.1% in the last policy to 5.4%. RBI remains optimistic despite global growth uncertainties, with real GDP growth for FY24 estimated to be around 6.5%. With a view to maintain price and financial stability, the RBI announced incremental cash reserve ratio of 10% on the increase in the net demand and time liabilities of scheduled banks between May 19, 2023 and July 28, 2023. This, however, was a temporary measure. Headline CPI inflation for July 2023 printed at 7.44%, significantly higher than the previous month's reading of 4.87% on a year-on-year basis. CPI inflation breached RBI's upper tolerance band of 6% after 5 months. The uptick in inflation was largely attributable to higher food and beverage inflation. On the positive side, core inflation printed below 5% level after 40 months, which might give the policymakers some relief and headroom to possibly look through the seasonal spike in vegetables. Bond yields remained flat during the month due to no significant event impacting yields materially. The 10-year G-Sec traded in a band of 7.15% to 7.25% and closed at 7.17% in August 2023. At the same level it closed in July 2023. At the primary auctions, yields on 91-day T-bill, 182-day T-bill and 364-day T-bill hardened by 10 basis, 15 basis and 10 basis respectively during the month due to the tightness in systemic liquidity caused by the announcement of incremental cash reserve ratio. Liquidity conditions remained relatively tight during the second half of August 2023, largely due to the 10% incremental cash reserve ratio announced by the RBI on 10th August 2023. Daily average borrowing through marginal standing facility window increased to Rs 347 billion in August 2023 from Rs 67 billion in the previous month. Average systemic liquidity surplus stood at 1.11 trillion in August 2023 as compared to 1.62 trillion in July 2023. Most recent credit growth stood at 19.7%. Marginally lower than 20.2% in the previous month. Credit growth was led by personal loans, services, agriculture, and industry in that order. Deposit growth stood at 13.5% with a marginal uptick over the previous month. We are in a world where glass remains half filled with water. Both the facts remain true. The glass is half empty and the glass is half full as well. Similarly, central banks today, especially the Federal Reserve, can argue that inflation is still high while the labor market is still very resilient. Conversely, a more dovish emphasis would be the lagged impact on the economy and aggressive cumulative tightening already done. Bond investors in India can also remain bearish based on the risk from high run rate of Brent, strengthening dollar and its impact on rupee, El Nino and its impact on inflation, as well as fiscal deficit, while yields can be capped due to bullish factors like potential inclusion in global bond indices, positive real rate environment coupled with softening core inflation, and relatively balanced demand-supply dynamics in the second half of the year. Given half glass full or empty narration, bond yields are likely to remain in a range with potential to break either way. Our base hypothesis is at this juncture to remain cautious and position for opportunities which may be available in coming weeks depending on incremental data flows.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.